It's Brian Preston, the money guy.
This next question, Brian, is from Chris. Chris said, I know the 23-8 rule, but is it okay to do a 6-year loan and plan to pay it off in 3 years just to have a buffer if something happens and you can't afford the higher payments? This is an interesting one, Brian, because I want you to answer this question. I want you to talk about what 23-8 is. I think that's important. I want you to talk a little bit about like his specific question. But we even used to see this with like 15 and 30-year mortgages. Should I do a 15? Should I do a 30? And the decision matrix has changed over the years. And I just think it'd be valid because if someone's watching this 10 years from now, maybe circumstances are different. Walk somebody through how they make that decision around like, what should make me do a shorter term loan, like a 3-year car note or a 15-year mortgage versus a longer term, right? And still paying it off in that shorter schedule. Kind of walk through some of that decision thought process.
And I love that this is financial mutant territory because so many other sites out there treat all their listeners and audience like you just can't be trusted. And I don't like that. I like how this is more of an adult strategy and the fact that 23-8, by the way, just to explain what that is, that's saying that, look, not a luxury vehicle, but just good, dependable transportation to get you to and from work so you're not losing your job because your car's breaking down all the time. 20% down. You don't pay for it longer than 3 years, and you got to make sure that monthly car payment is less than 8% of your monthly gross income. Yep. So that's the key part of 23-8.
And not just that car payment, all car payments. Yeah. That's something people ask us all the time, all car payments.
So people get caught up in that 3 years because I want the car paid off in 3 years because in normal times, there is fast depreciation. You lose a lot very quickly, so that's why you're paying it off quickly is you don't want to have negative equity or be underwater with it. But there is sometimes these financial companies, wherever you're buying the car or the bank you're dealing with will say, hey, 36-month rate is the same as the 48 or 60-month rate as well. So you sure you don't want to do the longer term? And that's where I think a lot of other pundits would say, no, you only should do the 36-month because you shouldn't trust yourself. But for myself, I would be a hypocrite because I have personally taken advantage of the longer amortization period because look, now you have to be good with your financial calculator because as soon as you go further out on the amortization or payback, your monthly payment's actually going to go down. That's why you have to calculate your monthly payment off of 3 years, not the 60 months or 72 months that Chris is asking about here, because you are going to pay it off in 3 years. But when they expand out that amortization and don't charge you a premium, what it does do is gives you additional flexibility. And that pivots to the point that Bo's talking about. Forever, and you heard a lot of pundits out there talking about 15-year versus 30-year mortgages, and it made a lot of sense when the material difference in interest rate, especially when rates were like 6 and 7%, you're like, yeah, on those high interest rate mortgages, and maybe we're headed back there, but right in this current lower mortgage rate environment we're in, you look at the difference between the 15 and 30-year and be like,
it's not much of a spread.
It's not much of a spread there. I could still have the goal of paying my house off in 15 years, but take the 30-year mortgage, be a disciplined financial mutant, pay it off whatever that window is that I have, because there's no prepayment on most of these loans, but have the flexibility just in case, I lose my job or I just have cash flow wise because I'm on bonuses or on commission that my cash flow doesn't come in. I can catch it up 1 month, or if there's a drought, I'm okay. That's why we like financial mutants. I'm going to give you the freedom to think like a financial mutant because you're going to respect that first ingredient of wealth creation, which is discipline. If you don't have deferred gratification figured out and you actually practice and do what we tell you to do, what are we doing here? I'm going to treat you like the adult you are, but don't disrespect the financial order of operation and all the rules we share with you.
And that's exactly right. And don't let yourself talk yourself into making a bad decision. So if you're the kind of personality that says, all right, I'm going to do this 6-year thing, and I'm going to put 20% down. So, because Jake said in here, hey, well, don't get underwater. Yeah, if you put 20% down, that'll protect you at least early on from getting underwater. If you're the kind of person that has that minimum payment and you're only going to pay that minimum payment, yeah, maybe you do need to force yourself to do that shorter note. But if you are a financial mutant and you know that you have the discipline to make hard decisions when you need to, by all means, give yourself flexibility. You're going to give yourself a lot of opportunity, just like you said, to adjust as you need to adjust.